Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is May 22nd, 2009, and my guest is Riccardo Rebonato, Global Head of Market Risk and Quantitative Analysis at the Royal Bank of Scotland, visiting lecturer in mathematical finance at Oxford University, and author of Plight of the Fortune Tellers. Our topic today is the insights of that book, Plight of the Fortune Tellers. And before we begin, Riccardo, I want to say that, let our listeners know, that this is really an incredible book. It has many thoughtful things to say about risk and uncertainty and the challenges of making financial decisions in an uncertain world. But more than that, it was written just before the crisis and was remarkably prescient in the dangers that were inherent in the environment of both private and public decision makers. I learned an immense amount from this book. It really helped me to organize my thinking about what went wrong in the financial system. And what I hope to do in this conversation is apply some of those lessons to what ended up being the reality of the warnings that you mention in the book.
Thank you. That's very kind.
I want to begin with a bit of recent history that you cover and talk about how banking changed in the 1990s and destroyed the 363 world. We mentioned the 363 world a long time ago for listeners, maybe 6 months ago, in a podcast with Arnold Kling, where we went back and looked at some of the history of finance and housing in the United States. But Riccardo, why don't you give us your take on 363 and what happened to the environment, competitive environment, and regulatory environment for banking in the 1990s?
Yes, so the 1990s has been, in 1990s and the few years of the century up to, I think the big sea change was at the end of 2006. So between 1990s, there was the hiccup of 98, with LTCM, Russia default, but that a posteriori, after the fact, that proved to be purely contained to the financial sector. It did not spill over to the real economy, and within 6 to 9 months, it was just a blip and it was forgotten. And what happened, well, perhaps it's a bit difficult to trace a coherent story throughout the whole period, but one aspect that was very important was that the regulators who look after the soundness of the banking system, of the international banking system, came to rely more and more on models, on quantitative models, and on the banking system being a forefront of risk management by making use of these quantitative models. If we step back a second from the technicalities, or actually if you do 2 steps back, we recognize that the underlying philosophy was a philosophy of faith in the self-regulating abilities and the self-regulating properties of a system which was managed by enlightened, self-interested managers and CEO.
Very skilled, very mathematically skilled, enlightened folks too.
Yes. Well, I think there was a big divide. I think that the quants, the mathematically skilled people, weren't necessarily so. They tended to come from a background, very often physics, very often mathematics, that was only peripherally touching. Very often they would have a smattering of a course in mathematical finance just before joining a bank, but the quants were not deep thinkers at all, and they were not people who had a deep knowledge of the banking systems. They were the tools. They were the tools is a bit unkind, but they were the instruments, if you want, of implementing the models that were supposed to guarantee that banks basically could not go bust, and that sufficient capital would be set aside in order to safeguard against extremely unlikely events. As we know now, that did not happen. And I try to explain in the book that, and the book, as you said, was written well before these events. And I was saying, we really are not in a position of saying anything about extremely rare events because we are collecting data with different frequencies depending on, in market data you might collect daily or intraday data. In the case of credit, it might be monthly or quarterly data. But at the end of the day, you have a few hundred or a few thousand or in market risk data of relevant points that span a few years. Now, this data give you information about what has happened in these last few years. And even if you were blessed with the abundance of data that goes back decades or goes back to the 1950s or 1940s or whatever, you have to make an enormous leap of faith to believe that these data are relevant to the present market conditions. Therefore, my contention was, more and more these models were promising to tell you about events that should happen once every 100 years, once every 1,000 years, once every 4,000 years. And I'm not kidding you. The 99.975th percentile one-year horizon corresponds to an event that should not, on average, happen more frequently than once every 4,000 years. And I was simply saying, how do we know? How can we extract this information from the data that we have? Now, the quants might have said we have very sophisticated mathematical techniques like extreme value theory, copula theory to determine the codependency. And I was saying, that's great, but how do I know that the data I'm using in order to calibrate these models are sufficiently homogeneous, belong to the same patch of history, if you want, in order to be giving me information that is relevant today and not information that was relevant about 3 years ago, for instance, when the world was quiet. And this was one of the central points that I was trying to make in my book, and in a way it has been a characterizing feature of the evolution of a banking system from the point of view, from the regulatory aspect, and from the impact of risk models into the practice of banking.
I've made a similar point here, talking about the Great Depression. That it's rather remarkable that we don't really have a consensus in economics or economic history about the cause of the Depression, why we got out of it, and what its lessons are for today. Part of that reason is it's a one-time event. It's hard to have a theory, or actually I should say it's very easy to have a theory of a one-time event. It's hard to be confident that it applies, say, today. And I think that is part of the problem, but it should warn the practitioner about it. It should induce humility. I suggest
absolutely.
Rather than hubris. Let's get a little more technical. One of the techniques that came to be popular in the banking system for assessing risk is value at risk. We've mentioned it on the show before, and I'd like to go into a little more depth on it. Describe the idea behind it and why it became so popular, not just with bankers, but with regulators as well.
Yes. Without going into technical details, value at risk is a statistic, is a measure of risk, and it has some very nice features. First of all, it's expressed in units that anybody should understand is money. So a value at risk could be 20 million. If I say your value at risk one day, 95th percentile is 20 million, what does that mean? It means that I should exceed a loss of 20 million only 5 days out of 100, because I've chosen the 95th percentile, so basically 1 in 20, 1 day in 20. So it gives an interesting piece of information, and when we are talking about something like the 95th or the 99th percentile one day, we are talking about events that should occur or whose severity should be exceeded only once every 20 days or once every 100 days. This is statistically doable. It won't be a perfect measure, but certainly this is an interesting and important measure that gives you an idea of your day-to-day volatility from the trading activity when nothing much happens, nothing extraordinary happens. Your typical degree of uncertainty for a desk, for a trader, for a group of traders, or even for a bank as a whole. And that is all good and well, but again, we should look carefully at the time frames we are talking about. We are talking about, can I estimate the type of losses that I will incur in a typical 20-day period or 100-day period. So business days, we are talking about 1 month or a few months. Yes, I think that we can. But when it comes to, so VaR, value at risk, was supposed to be used in order to determine capital. And capital is there not to absorb losses that occur once every month or once every few months, but it should be there in order to absorb losses that occur, once every hundreds of years.
Anytime. Because
Anytime.
The goal is to protect the solvency of the institution.
Indeed. And so the percentile will use 99 10 days. That already begins to be a bit of a stretch. So 10-day period, I have 10,000. I'm already getting, from the point of view of being confident that the data that I have in order to estimate this percentile is relevant to today, it's already quite a stretch. But even in this case, we are these losses are way too frequent. Therefore, the regulators, I think with a lot of common sense, slapped on a multiplier of 3. You do all these nice calculations. We don't ask you to calculate more remote percentiles. We don't ask you to calculate events which are more and more unlikely, and we just take a safety factor. The practice of safety factors has an illustrious pedigree. My background was in physics, and I know that my colleagues in engineering use all the calculations in order to that physicists devise the formula, and they use the same formula to calculate the thickness of steel ropes for lift elevators, and at the end of the day, they multiply by 10.
Just in case.
And when people do the same calculations for the landing gear of an aircraft, they multiply by 1.1. So there is always a safety factor, and I think it is a very sensible thing. So why was it sensible? Because it allowed the bank to calculate a statistical number which was somewhat meaningful, and actually quite meaningful in there. And then there was a multiplier that would translate this meaningful number into a safety adjusted number.
Because that really that's the goal of the regulator, right? The regulator, and I will talk more about this, but the regulator's goal is to prevent insolvency or disaster, because if it spreads, that's the entire financial system could be at risk.
Absolutely, because a bank is not like any other industry, but a bank has a systemic implication, and there is asymmetry of information, there are possibility of runs on the bank, all the things that we know perfectly well from the story, from the history of the 1930s, and unfortunately from the history of the last few years. You're absolutely correct.
So I just want to focus the listeners. I mean, the idea is, what nest egg do you have to keep? This idea of a capital requirement is you want to put aside a buffer that's large enough so that in the worst case scenario, your firm's still going to survive.
Exactly.
Now, here's the question. I want to ask a complicated question. You very eloquently point out in the book that there is an inherent tension between bondholders and stockholders in a bank, and between regulators and owners. And I'm a little bit confused about regulators and owners about the systemic risk, but I want to talk about how big that buffer would be without regulation. You're a bank. You need to attract. You call it economic capital. How much economic capital should a firm, in the absence of regulation, keep to entice its investors, both equity and bond, to be comfortable? So talk about how. I mean, it's in many. One of the things I learned from the book is that number is not really a precise, well-defined number. But talk about what some of the conflicts are.
Yeah, there is an excellent question, and actually, as I said, having written this book before the crisis, there has been a lot of thinking after the crisis about the alignment of the interests, even of an enlightened owner and of society. Let me explain a bit what I'm referring to here. First of all, economic capital. The idea is the amount of money, as you said, the nest egg, the amount of money that a bank would set aside in order to remain solvent, to be in business, even if an extremely adverse event has occurred. Now, how severe, how big this adverse event? Now, this is interesting here because the folklore came up with a number, and the number was a 99.975 percentile. So as I said, events that should happen not more frequently than once every 4,000 years. How was this magic number arrived at?
And what could be safer than that? Because we haven't even had banks for 4,000 years.
Exactly. No, we are being so unlucky. We had something that was supposed to keep us safe for 4,000 years, and after 3 years, bang, we got hit. That's really bad luck.
Yeah, life's tough.
So how did that number come up? Well, it came up from a completely different angle. Because actually, what a bank wanted to say to bondholders, saying, look, I am a bank of a certain chosen rating. I am a AA bank. Now, before the recent events, people could go down in history, look at what has happened, and look at the frequency of how many AA rated institutions went from being AA to default within 1 year. And if you put in the pot all different currencies, US companies, European companies, British companies, all types, etc., you have probably, out of a population of several thousands, you've probably found a handful. And some clever person has said, well, if I divide this very small number, companies which defaulted in 1 year, from AA down to default, over the total number of companies, I come up with this 1 in 4,000, approximately. Aha! If I want to give to my bondholder the signal that I am a AA company, I should set aside enough capital in order to convince them that I will only go bust once every 4,000 years. I am aligning the capital that I am holding with the observed frequency of default of a AA company in 1 year. That was the idea. What I was saying in the book is, that's a great idea. This is a signaling device, is the way whereby I tell, apart from the regulators, apart from the rating agencies, look guys, I am AA, and therefore you should give me money sufficiently cheaply. You shouldn't be asking for a great spread because I am a AA.
And in the case of a bondholder, the only thing the bondholder is worried about is solvency. They just want to make sure they get the principal and their interest.
They just want the money back. This is the tension that I refer to in the book. One not going for AAA. Well, that is good, but the shareholders might not be too happy because the shareholders care about the return on capital. So in order to convince the bondholder that I am AAA, I would have to hold so much capital that the stockholders would say, hey, wait a second, my return is not too great here. So there is this compromise between the shareholder and the bondholder, and for most banks, the equilibrium had been found around the AA level.
And as you point out, the tension also is because the shareholder, caring about return on capital, because the shareholder has this upside potential
Indeed.
that the bondholder can never enjoy. The bondholder is just getting this fixed promise.
Indeed, exactly. So if you look from the bondholder is shorter put. So the bondholder only loses money if things go extremely badly, if a company defaults. But when things go extremely well, he doesn't share in the upside. He just gets his money back with a coupon. It is different from the shareholder, who has, in a way, likes volatility because the shareholder is long a call on the assets of a firm. And therefore, this is part of the tension that I was referring to in the book. Now, please.
Go ahead.
An interesting point here is that the recent crisis has made very, very clear that a shareholder can be perfectly enlightened, can be perfectly rational, but can be willing to accept a level of risk that a regulator might not like. I am putting myself back at let's say, June or July 2007. A shareholder might have looked at shareholder of one of the banks who got in trouble to different extents, let's speak anyone, it doesn't matter, looks at the portfolio and says, for me to incur very big losses on this portfolio, I would have to need a repeat basically of the 1930s. The probability of this is extremely low. If I try to insure myself against this probability at this point in time, June, July 2007, I would be locking in losses which are most likely I don't have to bear, because in reality everything will come clean in the end. So from the point of view of a rational stockholder back in June, July 2007, it would have been perfectly acceptable to take that risk. This is the point where the regulators take a different view, because they say, aha, in your calculus of risk and reward, you don't fully take into account the systemic impact of your decisions. And therefore, I, the regulator, should be stepping in and saying, even if you like this risk, I'm afraid I won't allow you to take it. This is probably what they should have said, but everybody was lulled into a false sense of security by the once in 4,000 years economic capital that people said could be calculated.
I want to come back to the systemic risk, but before I do, I want to emphasize, and correct me if I'm wrong, that those investors and those institutions that were holding those portfolios had extremely high rates of return in the years preceding that turning point that you mentioned. So in the 03, 04, 05, 06, anybody who said, boy, you're taking a big risk, aren't you? Not only could they say, well, we're not going to have a Great Depression, so I'm not really taking as big a risk, but I'm doing really well along the way.
Not only, but if someone had said, oh, let's pull the oars in, this is getting a bit out of hand, this is a bit crazy, your competitors weren't doing the same. You would have been lagging behind. And it is extremely difficult, this is one of the points that I make in this book, to convince the stockholder, the shareholder, look, I am being prudent, and these guys are going to end up in trouble in 1, 2, 3, 4 years' time. You know, in a way, in 2006, there were plenty of signs that money was too easy, liquidity was too abundant, risk premia had been compressed too much, asset prices were too high, and it was like, if you want, the fracture line of an earthquake. People knew that sooner or later something was going to give somewhere. It was extremely difficult and well nigh impossible to predict where, but it was a generalized consensus that it was not sustainable for a long period of time. Where and when the crack would occur, obviously, is completely different. I'm going back in 2006. And if someone steps out a bit too early, it is absolutely disastrous. Let's not forget that the irrational exuberance expression by Greenspan was uttered in if I'm not wrong, I believe it's 1994 or 1996. So if someone had pulled out of the market at that point, he would have had to explain to the shareholders for 5 or 6 years what he was doing when everyone else was becoming rich.
And there's both there's a competitive market issue. There's also almost, I think, in this world, a social issue. It's a small world, the investment bank. So you're going to events and parties where your neighbor is living very high, and you're telling your shareholders he's a fool, but he's doing very well.
Yeah,
and
absolutely.
you look like the fool, at least in the short run. But it does raise the question, which for me is one of the central questions of this catastrophe, which is the following. I've heard that story before. It's a version. There's different versions of it. One version is, if that's the music that's playing, and you're there to dance, you got to dance to the music. So, if everybody's investing in these mortgage-backed securities, sure, maybe they're not AAA, or maybe they're not really. This tranche is not as reliable as it is claimed to be. Maybe the rating agencies are co-opted, but hey, it's the only game in town that's going wild. So I got to get in. I got to make sure that my clients, my staff, we're all sharing in this glorious success. And yet there were people who did not play along. There were, I think, quite a range across institutions of how much exposure they had. Why? Do you have any speculative thoughts? Bad choice of words. Do you have any thoughts on why institutions differed by how much exposure they had. So, for example, you have Bear Stearns and Lehman Brothers. They go out of business. You have, quote, more prudent, I think, institutions like J.P. Morgan and Goldman, and maybe that behave differently.
Yeah. Yes.
Any thoughts on that?
I think that there are, it's extremely difficult to speculate about different institutions. These are just my guesses. I think that there have been the institutions who have been into this game. Had been into this game for a very long time, so they made a lot of money, and they were big in this area. They were the latecomers, and these fared worse than everyone else because they had not made the money before. They were seeing everybody at the party, and they wanted to join the party, so they began building their portfolios basically when the party was about to be over. There were some really smart guys, probably the Goldman Sachs and the J.P. Morgan of this world, but in a way, very, very few and far between. And I think that the different levels of inventory, if you want, simply reflected the different stages in which different institutions were in getting into this type of business. But again, now we know that this was the business that was going to crack, but it could have been in many, it could have been emerging markets. Actually, emerging markets were extremely resilient, but there were so many, all the risk premia in all the risky assets were being compressed. I remember in, I believe it was summer 2007, and there had been a wobble in emerging markets, and after the wobble, a head trader of an emerging market desk said, this week there has been panic buying of emerging market paper. Panic buying. So people have been out for a week. Oh my God, I've lost my carry for a week. So there were many areas, and therefore it would have been extremely difficult to say a priori exactly where it would have happened. There were signs, as I said, just by the sheer compression. By risk premia, I mean the compensation that is paid by a security for you to bear risk. And for the same amount of risk, less and less premium, less and less compensation was being paid. So if you wanted to make the same absolute return, you had to take more and more risk.
Yeah. Now, some people have said that that this problem would never have happened if the investment houses, especially in the United States, had never gone public. That part of this problem is a asymmetry of incentives facing traders, say, and executives, and on the one hand, and stockholders on the other. The claim is if they'd been playing with their own money, they never would have done this. What do you think of that argument?
Again, after the fact, these people sound absolutely right. Again, I am saying that before the fact, it was not necessarily, and I'm putting my mind back to late 2006, early 2007, it would have been from the point of view of a private firm, it would have been a reasonable risk to take. Now, a reasonable risk for a private institution needn't be a reasonable risk for a system, and this is where the regulator should step in, creating a level playing field. Because the only way, if I step off the bandwagon, I will be at a disadvantage with respect to the more reckless person or the more reckless institution who remains on for 2 or 3 more successful years. Well, yes, it might blow up in 2-3 years' time, but I will be dead by then anyhow.
Because people will have withdrawn their funds from me would be the worry.
Oh,
right?
Absolutely. I have a vivid memory. An excellent asset fund manager in the UK, I won't mention any name, stepped out of a dot-com bubble a tiny bit too early, and he got fired 3 weeks before the bubble burst. If a quarter you post a negative or not as positive a return, or actually if you go short the underlier that you perceive as too expensive, you will be showing a negative return when everybody's getting rich. And a quarter, second quarter, third quarter, people say, sorry, I'm out. You might be smart, but it is extremely difficult to swim against the tide. And that is exactly where the regulator, when they perceive that there is a generalized asset bubble, should intervene to level the playing field and to say, okay, you will all be not prohibited but inhibited from taking this type of risk. But again, I'm not pointing fingers.
I'm not saying it is. We're going to come back to that. Yeah. Well, don't worry. We're going to come back to that. But that brings to mind two questions. One is the amount of leverage that was at play here is part of the reason these gambles were so large, right? One of the puzzles I've always had when I first started trying to understand this is, it's one thing to say, well, you had a bad quarter, Bear Stearns. You had a bad year. But why did you take such a roll of the dice that these losses in the U.S. housing market destroyed your legendary company? And the simple answer, and it's a simple answer, the simple answer is, well, because they were so leveraged. They had borrowed so much to finance that gamble that losing the gamble didn't just mean a bad quarter, it meant death. So that's point number one. And you can comment on a sec. Point number two is, when you talk about the people who swim against the tide, I think the standard argument you hear is, well, investor psychology is such that, when things are going so well, no one's really worried about risk. And it raises the question of, in the current environment, I suspect that the psychology is going to go the other way. Aren't people going to get a little more prudent? Isn't one of the reasons they were so intolerant of prudence is they'd had such a long run, maybe unparalleled, of asset appreciation. And now we've learned a lesson, and maybe there will be more self-restraint.
No, to some extent you're absolutely right, and I agree with you. And there has been a very good book by Ackleroth and Schiller, Animal Spirits, that highlighted the importance of sentiment and how people extrapolate into the future and have reversals of sentiment, and how these affect both financial markets and the real economy. So from that point of view, you're absolutely right. It is
that may be the only thing I agree with in the book with Ackleroth and Schiller, but let's keep going. It's an interesting book.
And what I was trying to say is, yes. It is extremely, at the present moment, there is an enormous amount of uncertainty about whether we're going to get out of this very deep recession very quickly, like a V or the double V. I have heard all kinds of letters to try and describe the shape of a getting out, but there is also a possibility, it is a nagging thought in the back of one's mind, especially the nagging thought in the back of a risk manager's mind, that things might not work out as plan A or plan B, and we might actually be at the beginning of a depression. And at the moment, there is, if you want, every piece of information that arrives has the ability to shift the mood very, very dramatically, because we are in a very uncertain and unstable state. Therefore, a week ago, as we speak today, it is the 22nd of May, a week ago, well, it's all over. The bad times are over. The stock prices are going up all over the world. Emerging market spreads are coming down. We're going to be out very, very quickly. And then there have been a couple of pieces of news which are not really dramatic, nothing substantial in the big picture. And all of a sudden, there is a much darker mood a week later, and there is nothing stopping me from thinking that next week it might be different again. So are we becoming more cautious at the moment? I think we will become more fundamentally cautious if there is a more protracted period of uncertainty, instability, and decline. If we get out, if Plan A works beautifully, and we get out with a V-shaped recovery, I would expect that risk aversion will disappear much more quickly than we think possible today.
I totally agree.
And that is good and bad.
Yeah,
that is totally good, obviously, because it means that we get out of a recession very quickly, but the same search for yield that has created the situation we are in, it means that it would not, if people begin to remortgage their properties in order to extract equity, in order to spend, and etc., that is not, instabilities will represent themselves.
Yeah, well, that's this related question of where that liquidity is going to come from. And of course, we may talk about that later. But before we get there, tell us what Basel II was about and the idea of regulatory arbitrage. Explain what that is, and then...
Well, regulatory arbitrage might be dead. Basel II was a very worthy enterprise, was trying to make the capital that a bank has to set aside more aligned with the risk that the bank takes. Basel I, there were some very formulaic rules, where every rule is formulaic, but they're very rigid rules and very, very simple rules that did not really reflect the risk taken by banks, or rather the capital that was set aside according to these rules did not really reflect the risk taken by banks. To give you one simple example, there wasn't a great differentiation about the creditworthiness of the bonds that you hold. So governments or OECD were considered very, very, very safe. Bank of OECD countries were considered very safe. But then there was very little differentiation between lending to a AA company or lending to a corner shop. So if I asked to set aside the same amount of money for $1,000 lent to IBM or lent to the corner shop, well, I get a much bigger bang for the buck if I lend the same amount of money to the corner shop. So that is an element of risk misalignment, if you want, that Basel II was supposed, and to a large extent does, remedy. So the idea is good, the idea is sound. Perhaps the techniques that have been used, I think there has been a overconfidence in how much we can quantify using statistical techniques, and what I call in the book frequentist techniques, exactly the risk of the different activities. If it had been left somewhere in between the Basel I approach, which was very broad brush, and the super quantitative approach of Basel II, we might have been in a better place.
Yeah, it comes back to the hubris again, I think, of overestimating what we can know and measure.
Yeah.
Now, how did the ratings agencies come into it? You talk about that in the book as well. How did they come into this regulatory arbitrage issue with respect to Basel II?
Clearly, I'm not privy exactly what happened inside, but the setup was not good. And the setup I'm referring to is the role of the rating agencies with securitization. Securitization is a process whereby banks accumulate assets, accumulate mortgages or other type of assets, package them. So they accumulate diversified assets, if it is mortgages from different regions of the United States, for instance, if it is bonds from different sectors of the economy, etc., etc. And by virtue of a diversification, they create a portfolio that is less risky than any individual component of the same rating of the portfolio itself. Then they present this portfolio to the rating agencies, and they say, let's tranche this portfolio in different sections. The first section will bear the first risk, the risk of the first losses, and therefore will get a lot of return in terms of spread,
if things go well.
All the way up to AAA. Now, the rating agencies were supposed to be the impartial observers of whether the mix of the securities had been done well and they were sufficiently diversified in order to provide enough diversification to bring the securities indeed to the AAA level, AA, single A, etc., etc. The problem here was that one is, if you want, human nature, and the second one is conflict of interest. And the conflict of interest that the rating agencies only got paid if the securitization went through. And the rating agencies actively worked with the investment houses to structure the portfolio so that it would meet the criteria that the rating agency had set for AAA, AA, and single A rating. So the analogy that I make here is a school teacher who sets a very, very tough test for the students, but gives a question to the students the day before.
Right. Because
the test is very tough, but I've given you the question yesterday, and not surprisingly, you presented me a portfolio that exactly meets the specific requirements that I have set out yesterday. Yeah, you get your AAA and I get my fees. But it's obviously not the best way that this system can be set up.
But if I were to hire or interview a student from that school with a good grade, and I knew that that was how the school operated, I'd be a little skeptical. So everybody knew this about the ratings agencies. They all understood this. So I've never understood this claim that this was everybody knew it was a conflict of interest. It wasn't a secret.
That is a good observation. But I had heard in those days is there is a value of our franchise. Remember, it was the days,
True.
and we're only talking about 18 to 24 months ago, when the general mantra was the enlightened self-interest of market players was the best safeguard for the financial system. So the idea was, if the rating agencies debase the currency of their name by giving away the AAA for nothing, they will lose credibility. It was the efficient market, self-regulating efficient market, and this was just one of the aspects.
Well, I'm a little more, maybe a lot more favorable to that argument, and we will come back to it. Before we do, I wanted to ask you, do you want to say anything about mark-to-market and what role it played in the crisis? Some people have suggested it's the whole problem. Some people have said it's irrelevant. Everybody knows what the value of these things are. It doesn't matter whether you put them down in the accounts or not. What are your thoughts on that? This
is a very controversial topic. What I would say is, I don't think it is fair to point the finger to the mark-to-market. It's like saying, if I didn't have a thermometer, this patient wouldn't have a fever. To me, that doesn't sound quite right. There has obviously been a dynamics of the mark-to-market forcing and influencing certain actions and disposal of that. So one of the nexus where the mark-to-market got things a bit into trouble was the fact that when securities got downgraded, certain institutions had to sell them. And this caused forced unwinding, or when there was unwinding of SIVs, you remember the SIVs of 24 months ago,
special interest vehicles.
Special investment vehicles that everybody was talking about and nobody talks about today, etc., etc. So, in general, the mark-to-market is good when there is a willing buyer and a willing seller. And therefore, in these situations where the equilibrium between the willing buyer and the willing seller occurs, then there is a good information about the fundamental value of whatever is bought and sold. If for any reason there is an unbalanced wave of selling, or for that matter of buying, I might add, but let's stick with the selling at the moment, the mark-to-market ceases to have the same information content that it normally does. Now, you might say, well, why is it that the buyers are no longer there? And it could be because all of a sudden liquidity disappears, balance sheet becomes extremely precious, and what are called technically the pseudo-arbitrageurs, the market agents who bring things back towards fundamentals, don't have the firing power to deploy their assets, to deploy their money, Mm-hmm. And therefore, there has been I can see the two sides of the argument. I mean, mark-to-market is not necessarily, it doesn't have any intrinsic value as truth unless the market is sufficiently liquid. Only in that situation, it is a good reflection of the intrinsic value of a security. If the market collapses, if the market becomes dysfunctional, then it becomes a rather meaningless number. On the other hand, that is the price for which you can get something off your balance sheet. So there is some information there, still there. So it is a controversial point, and I know that so much has been written. I don't think I can add much to the discussion, but I think the central point that has motivated all of a sudden the suspicion of the loss of trust in the mark-to-market has been the fundamental disruption of a market, of a liquid market, to such an extent that one can no longer have the faith that the price reflects anything about fundamentals, or rather simply reflects the vagaries of today's supply and demand.
But isn't there an interesting interaction between the mark-to-market accounting and the requirement and the regulatory capital buffer. So, for example, if I'm holding an asset, and you discuss this very, very subtly in the book, very nicely. If I'm holding an asset I'm going to hold it for say 5 years. It's got a whole bunch of mortgages. They're going to be paying out over that time. Some of them are going to, of course, go into default. Some will be prepaid. There's interest rate risk, et cetera. But many of these, I'm not going to resell this. If in the meanwhile there's an increase in the foreclosure rate and the default rate, the market value of this goes down, I may not be in compliance with my capital requirements today, but over time I might be fine on a cash flow basis. I think that's the only part of the mark-to-market argument that I find somewhat compelling because of how it interacts with my capital buffer. So I'm forced to sell it. I wouldn't sell it normally. It's not an economically destructive thing on my balance sheet, but for capital requirement regulatory purposes, it's become one. Is that true? Or I have that story right?
Yeah, I think there is a piece missing, that there is a choice for most securities. Well, once the security is created, you don't have a choice, but how you structure the transaction gives you a choice whether to place it on what is so-called banking book or on the trading book. And there are pluses and minuses to both. Typically, the trading book attracts less capital, but it forces you to the discipline of a daily mark-to-market. So perhaps people have been placing into the trading book when the sky was blue, liquidity was high, and you could find prices almost for everything. A lot of things in the trading book whose prices then disappeared when the liquidity was withdrawn. But you always have the choice, or not always, but very often have a choice with a loan. Do you consider it a traded loan, in which case it is reasonable to put it on the trading book? Or do I consider it a loan that I'm going to hold to maturity, and therefore I'm going to keep it on my banking book, and I will get a different capital, which is higher at the beginning, but a different recognition of a value. Unless there is impairment, I can still recognize 100, and if it pays down 100 at the end, I'm fine and I don't have to recognize any losses. So is not so clear-cut. You have choices that you can make, and the choices that were made by preference in the year up to 2006, 2007 was to place instruments in the trading book, partly obviously because it attracted less capital, and partly because the liquidity was so abundant that you could find prices for almost anything. And therefore it was well justifiable in those blue sky days to put these assets there.
We're running a little short on time. I want to make sure we get to two topics. The first is too big to fail, and the second is the systemic risk issue. I'm a big fan of enlightened self-interest, maybe just self-interest, because I'm not always sure what that enlightened means. But many of our guests here in the past have argued, and I'm sympathetic to the view, but it may not be true, have argued that too much risk was taken because at the backstop, at the end of the day, too big to fail, or U.S. central bank behavior would eventually bail out these bad decisions. So the argument goes like this. In the United States, we have banks that are FDIC regulated, and we put a lot of regulations on them as to what they can do with their money because we've guaranteed their deposits through the government. Then we have this so-called shadow banking system, the investment banks. Yep. They are not guaranteed at all, and yet it turned out, of course, that they kind of were. Not every one of them. There was an erratic decision. Lehman Brothers died, and Bear Stearns had to be sold at a discount, but Merrill Lynch got forced sold to Bank of America. AIG's been made whole all the way through, which I think has been a ghastly mistake, but that's life. But I'm more interested in the question, on a day-to-day basis, how much was there a socialization of losses and a private set of gains? We saw it in Fannie and Freddie here in the United States. That obviously turned out to be a catastrophic institutional structure that was implicit, turned out to be true. And unfortunately, it's turned out to be true for many investment banks that in theory weren't guaranteed at all. Yep. So were they being rational in rolling the dice the way they did?
This is an excellent question, and this is just speculation. My answer is purely speculation. I see the logic of your argument, but if instead of thinking of an institution in the abstract, I think of the actual decision makers, I don't actually buy very much the rolling the dice because I'm too big to fail argument, for the following reason. Perhaps the institution might survive, but as we have seen, the individuals don't. And it is the individuals and not the institution who made those choices. So it would be a strange person who has an incredible loyalty and affection for the institution and says, as long as the institution survives, I don't care if I die, and therefore I will roll the dice. The CEOs who made those choices are not faring very well today. And therefore, from their point of view, I don't think that they were really banking, oh, well, if things go badly, I'll be bailed out. Well, perhaps my institution will be, but I will not.
I'm a little surprised because you could argue it goes the other way, that a lot of traders made a great deal of money along the way, and although some CEOs were both humiliated and financially destroyed, stockholders, Bear Stearns being one example, others turned out fine. As you know, AIG is still thriving in its own peculiar way. So, do you think there may be some truth to it?
Well, I don't know. This is again purely speculation. By the way, the CEO of AIG has announced his resignation today, and he has said, "I'm leaving the most horrible job in the world." Yeah. So
it's been a great deal of fun. Yeah.
Yes, and it's also before the event. You cannot know whether you're going to be one of the survivors or one of the ones that are going to not survive. So, if you look from the point of view of the institution, the argument looks okay. But if you look at the individual, I don't think that in the back of their mind, the too big to fail played too much of a role. You know that if you're rescued by the government, you have lost control. You're basically out in one way or another.
Well, let's turn to systemic risk. This argument that there is it's essentially, in putting it in an economic framework, there's a negative externality. So when you take a risk that turns out to bankrupt your firm, you want to avoid that, but you're not as careful as you would be if you had to bear the social costs of the other firms that are going to be called into question. Yeah. And I want to go back to, as I've done with many guests when we talk about this, I want to go back to March of 2008. Which for me is the turning point when the government decided that it was going to be the U.S. government was actively involved in the financial system to a degree that was unimaginable before that. So in March of 2008, a weekend came along where Bear Stearns informed the Fed and the Treasury Department that they were not going to be able to meet their obligations on Monday morning. Yeah. And the claim was, so that was never made, I think it's a real failure of democracy, that the Fed and the Treasury Department never explained the nature or urgency other than to say that it was urgent and it had to be done. That the U.S. government could not allow Bear Stearns to fail. Now there's very, as Alan Meltzer pointed out on the show, there's been very few cases where the government let firms fail, which is part of the problem, I think, of incentives. But the claim was that if they had failed, so much would have cascaded down from that. Then, of course, a few months later in September, they let Lehman Brothers fail, and people have debated about whether that was a triggering moment for the real crisis. But we have some information now about what happened to Lehman Brothers' assets. They've gone through bankruptcy. And the claim was in March that if Bear had been allowed to go through that experience, everything would have frozen up. Now, it kind of froze up anyway. The whole system had a lot of problems. But do you believe that was an unsustainable event, that had Bear Stearns simply gone through the normal procedure of bankruptcy, that there would have been catastrophic consequences? And it's obviously speculative. We can't know. But
I believe it would. I believe it would, simply by seeing what happened. Well, I think that everybody, including the regulators, including the best minds in central banks, they were making it up as they were going along. And I can't make any names, but I know senior people in central banks there were intense debates. There were intense debates regarding, should we make the market work out its own problems, or should we intervene? And if you look at records of different central bankers were more averse to central banking intervention, or in your case, the Fed or the central bank. And people were experimenting. And when there was the rescue of Bear Stearns, some central banks said this was a mistake. And I have spoken with some individuals who at the time were opposing. And when Lehman came around, the people who were, let's say, more market-oriented had the upper hand. After seeing what happened, that's it, no more. So personally, I think that we would have had a repeat, or not a repeat, but a preview of Lehman's in March.
Yeah, it's hard to know, though. The reason I say that is, John Taylor, who is, and I'm going to come to his claim in a second, his other claim, but one of his claims is that the spike in the spreads really occurred after the Lehman Brothers failure, not concurrent with it, and it was really the TARP bailout that really spiked interest rates, and not the Lehman Brothers.
I don't think so. I think that at that point, I think that there was real panic because no institution at that point was sure to be safe. Every single bank said it could be me next week. So when people saw that even a bank as illustrious as Lehman had not been rescued, there was a sense of panic. And runs on banks were beginning to happen all over the world. The slightest noise was prompting depositors to take their money out, and depositors, and where do I go? I think that is a bit of an optimistic version. But again, this is, pure speculation.
Yeah, that's a fascinating
counterfactual.
Yeah, it's fascinating, and of course, when you talk about regulators being in the dark or unsure, feeling their way, of course, they face their own unique set of asymmetric incentives, which is, I think, in the United States, I think Ben Bernanke, as a authority on the Great Depression, was extremely eager not to have a Great Depression on his watch. Maybe too eager. Yeah. I want to close with a more European perspective. We've talked a lot about the United States. There is a tendency, and I'm guilty of this as well, and I'm worried I'm wrong, so I want to get your thoughts. There's a tendency to blame much of the crisis on various U.S. policy decisions that inflated the housing bubble. And there's plenty of blame to go around. The United States, beginning in the early 1990s, and you could even trace it back to the 1930s under Roosevelt, the United States has eagerly subsidized the demand for housing and pushed up the price of housing, and particularly in the 1990s, did a bunch of policies that inflated housing prices and made some of this possible. But a richer view makes the observation, and that story, blames tax policy, it blames Fannie and Freddie, it blames the Community Reinvestment Act. These are all U.S. policies that had an effect on the price of housing. The question is whether that effect was large enough of a magnitude to explain what's going on, and that I think people have not made the case in a rigorous way yet. So here's the question, though. Those of us who are sympathetic to that argument often ignore the fact that there were dramatic housing appreciations throughout Europe. There was Spain had a big inflation of housing prices, Ireland, and around the world, South Africa and elsewhere. Australia. Yes. So I'm curious whether, now, one argument has been made, particularly by John Taylor, as I mentioned earlier, that these are all part of the same problem. It was an excess of liquidity searching for yield being pumped out by the U.S. central bank and maybe other central bankers. Do you have any thoughts on why the worldwide housing appreciation occurred? It wasn't worldwide. It was in certain countries at certain times, and it wasn't nationwide. Even within the United States, for example, much of the housing appreciation was geographic.
So, first of all, I think that when something of a magnitude of what we have been observing occurs, there is no single cause. It is a conflict. It is a perfect storm. You have 5 or 6 weather fronts arriving at the same point. We should not forget, for instance, the trade surpluses run by many countries like China, who prompts them to invest the funds in treasuries, depressing the yields and pumping liquidity into the system.
And into Fannie Mae, which is pumping it into housing in particular.
Indeed. Now you say, why housing? Well, if you look at the environment with pretty low, what I was talking about the risk premia before, pretty low return on lots and lots of assets. I can take a lot of risk in emerging market in 2006 for a really paltry yield pickup. For many investors, the obvious thing, solid as houses, was to invest in houses. And more, the instruments to create the leverage via mortgages and the buy-to-let in this country, and we know the home equity refinancing in the state, etc., allowed the looking at housing not as a place to live, but a place to invest. And so there was one bubble that was created alongside with many other bubbles. This is the one that burst, probably because, one, of the magnitude, two, because of the complex and leverage of the instruments that became attached to the mortgage-backed securities. Yeah. And I think no single, yes, the government was, if you want to say, with hindsight, aiding and abetting the increase of investment into housing, etc., but I don't think that was the only cause. In many other countries, as you pointed out, there was exactly the same, and I think it was money chasing places to go.
But why Ireland and Spain and not Italy and France, or is it just small?
I think there's. I would have. To give a serious answer, one has to look at data. I would point to the availability of mortgages, but again, it's difficult to tell. Yeah. It's difficult to tell without looking at the data.
My guest today has been Riccardo Rebonato, author of Plight of the Fortune Tellers, a book I strongly recommend. Riccardo, thanks for being part of EconTalk.
Thank you very much.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.